Manishi Raychaudhuri is with us, Asian equity strategist, equity cash Asia Pacific at BNP Paribas. Manishi, good to have you with us here. Thank you very much for your time. Are we beginning a bit of a global correction in your opinion? What is your global team's view?
That correction began some time ago. It coincided, and not surprisingly, with the US bond yields spiking. In this particular case, it was accompanied, somewhat surprisingly, with global energy prices, oil prices also going beyond 90, now approaching 95 to the barrel. And both these variables are actually, not quite helpful for Asian equities, particularly Indian equities. We have seen, consequently, the Asian currencies depreciating, and we think that this situation is likely to continue for some more time. So essentially, this is not really an India-specific phenomenon. If we are seeing it across emerging markets, whenever you have the US dollar appreciating, the US bond yields spiking, there's a flow of money in favor of the safe haven destinations like the US markets. And, I think this kind of a situation may continue for some more time. Now, having said this, India is in somewhat of a sweet spot, when it comes to protection that the market has because of domestic fund flows. This is something kind of unique to India. Almost no other emerging market has this advantage to the extent that India does. So I would think that the entire emerging market complex, the Asian markets, would possibly continue to have some correction. That said, the outperformance by India, even in that corrective phase, would likely continue.
Manishi, morning. Reema here. Just to, labor on that point that you were making about the global markets getting into a tired sideways movement, as you call it in your report. You're saying this currently what we're seeing is similar to what happened in 2002, 2003. And at that time, the market declined. Then it drifted throughout Fed's rate cut period as concerns about a sharp economic slowdown became apparent. And the recovery started only after the Fed rate cuts were almost over as the liquidity injected began seeping into the various financial assets. So are you saying we're in this grinding kind of period for a very long time, even as the Fed starts its rate cutting cycle? Perhaps sometime next year, markets are still not going to react positively?
I would think that this, tired sideways movement, which, very correctly quoted from my report, is likely to continue for, maybe another 3 quarters or so, maybe till the middle of 2024. We're in exactly that phase which we encountered, from mid 2002 to mid 2003, where the markets were directionless. The earnings estimates were, kind of coming down, but selectively, very selectively staying stable. And we're possibly in that kind of a situation right now. What would be necessitated to, sort of take the market out of here? We clearly need to come out of the recession narrative. And that narrative, unfortunately, is likely to continue until and unless the recession is actually over. And our global economics team thinks that that period would coincide with the first and second quarters of 2024, where we will have a shallow recession, but a recession nonetheless in the United States. Mid-2024 would also coincide with, hopefully, the end of this higher for longer period. We think there could possibly be one more rate hike in November, but after that, there would be an extended period of higher for longer, maybe for another 3 quarters, and rate cuts would commence only in the second half of 2024. So when I put all this together, the macro variables would turn favorable for risk assets only in the second half of 2024. Until then, I'm afraid we may have to contend with this sideways movement.
Hi, Manishi. Manishi, what about HDFC Bank that's already been underperforming? It's not even sideways. It's actually down close to around 7%. And I think in the last 10 years, we haven't had a single year when HDFC Bank has given negative returns. And we just have 3 months to go. So hopefully it keeps, that record in terms of positive closes in a calendar year. You've liked private sector banks. Where does HDFC Bank feature in that list?
Right. So, I wouldn't obviously comment on, stock specific here. But in general, as you rightly point out, we do like the private sector banks in India, and we focus on those banks which are gaining market share. The entire gamut of private sector banks in India are gaining market share over the PSU banks. But even within that set, there are a few which are actually, for more adept at cost cutting because of better technology that they have. They're also gaining market share as a consequence of that better technology that they possess. And, and those are the banks that we're focusing on. So that, it's certainly, that's the story that would pan out, not just over the next 1 to 3 years, but even for much longer.
Right. Manishi, sorry, this, we're in a place where oil prices are up 30% from June, the dollar is higher, etc., which some of this you would discuss. But then on Friday, we got that global bond index news flow, right? So should we look at some of these, the two big global variables for India, dollar and oil, a little differently? It would still hurt, but maybe to a lesser degree. What's your sense?
I do tend to agree with that. If one looks at the global bond index inclusion, from the debt markets, we have the feedback that it would lead to anywhere between 25 to 30 billion inflow on the lower end of the estimate range, and possibly somewhere around 45 to 50 billion on the higher end of the estimate range. So that's significant. And that inclusion is happening in June 2024, which would obviously have a salutary effect on the currency. Now, that said, it's going to be a long, drawn-out affair. It'll basically pan out over the next 9 to 10 months. And before that, we will have to contend with higher fuel prices. We must also keep in mind that we're entering the winter season, where obviously there's a degree of pressure on the oil prices in the upward direction. So it's basically.
Oops. Okay, I think we lost the line there. There was a free stream, but we'll just have Manishi back to complete that point. The index is now coming back into being absolutely flat. We were down about 20, 30 points. We're down 2.5, so absolutely flat now on the Nifty. Just take a look at the Nifty Bank as well, which outperformed what the Nifty did. The Nifty corrected on Friday, but Bank Nifty ended unchanged. It's already in the green, the Nifty Bank that is. Just to kind of go back and look at stocks, etc., Berger is the only significant kind of loser with about a 4.5% cut. There is, of course, the news-related ones, Religare and Delta. Religare, by the way, is also picked up. It was down 6.5%. Religare is now about just 2.5% lower at 264 or so. So, a fair bit of pickup from the low point of the day. Manishi, I believe, is back with us. Manishi, please, we lost you there. Go on.
Yeah. So I was talking about this bond index inclusion, and there's a significant degree of flows expected, possibly about 25 to 30 billion at the lower end of the estimate scale, 45 to 50 billion at the upper end of the estimate scale. So this is significant, no doubt, and it would support the currency. What we have to contend with is actually the near term. When oil prices would likely continue to be firm, we are entering the winter season now. So I think, when it comes to this question of currency, there's a degree of difference between the near term and the longer term that investors would have to contend with.
Manishi, wanted your thoughts on Indian industrials. In your portfolio, you do have holdings in L&T and BEL, so you are playing the Indian industrial space. The question is, how long do you think this government capex will continue? They've been spending massively, but can we assume this kind of government spending for the next 3 to 5 years? Are we closer to the end of this upcycle in industrials, or it's just gotten started and you would play it for the next 3-5 years?
We would definitely play the government capex theme, and therefore the the consequent spilling over into private capex. We must remember that private capex hasn't really started in a big way yet. You rightly point out, and this is something we have been arguing as well, that if you look at government capex in infrastructure, in railways, in defense, all put together, capex as a proportion of total government spend has skyrocketed over the last 3 years. It used to be about 17% of total government expenditure. It has gone to about 25 to 27%. The only risk to this could be, a spike in the fiscal deficit. Now, if I look at the tax collection that we're witnessing at this point of time, that doesn't seem to be a very potent threat at this point of time. So, looking at the government's intentions in terms of supporting capex and improving infrastructure, I would be willing to bet that this government capex would likely continue for over the next 2 to 3 years at least, and the spillover effect in the private capex would possibly accelerate. So yes, we are currently overweight. We have a significant allocation to Indian industrials in our model portfolio, and we see no reason to alter that.
Manishi, great conversation. Thank you very much for joining us this Monday morning. Let's